Good evening, sir.
Hello, good evening.
How are you,
Hope
sir?
you're doing. I'm doing well. What about you?
Doing good, sir.
So we are just starting within a minute or two, so that other participants may join this meeting. Then we can start.
Sure, sir. Sir, what will be what you will be covering today?
I would be sharing today's agenda once the other participants join. Then I would be sharing all the things in much detail.
All
Don't
right,
worry,
sir. Thank
please.
you so much. Thank you.
Hello, everyone. I hope you all are doing well. Please, can you confirm I'm audible to all of you and is my screen clear? Can you please answer these two questions? You may write in the chat box. After your confirmation, we can start discussing today's agenda. Thank you. All right. Thanks for your active participation. My name is Rana and I'm ACCA member, currently teaching taxation, the financial reporting, and the advanced taxation paper. I'm in teaching profession since last 9 years. And my core areas, as I told you, the taxation and the financial reporting. As you have many questions with respect to today's session, that which things we are going to cover today. So let me share you that agenda for today's discussion. Basically, in yesterday's class, in yesterday's session with Sir Kumber, you dealt with section A type questions. So now today's agenda is to deal with section B type questions, and mainly we have practice exam 2 questions. We are going to attempt section B of the practice exam 2, the question number 3 and question number 4. As we know that all of the questions, and these have to be attempted in a timely manner. How you can do all these things in a timely manner? Please try to practice each and every question from your exam kit while attempting the past paper questions. Try to attempt that question in the assigned time, so that it would be helping you out while your real exam scenarios. So as I told you, today's agenda is to deal with the practice exam 2 section B questions, the question 3 and 4. And the practice exam 2 is available on the ACCA You may visit this site. You can visit to the past papers, CB practice platform. Over there, you would be getting this practice exam 2. And I want to ask few questions from you guys, and your responses are highly appreciated. Please, have you attempted any question using this CB practice platform? Yes or no? Yes, Joy, Wahab, and rest of the others, please. Have you attempted any question using ACCA CB practice platform? Okay, it means you are aware of the paper format, that normally the scenario exhibit and the requirement exhibit, all things are given on the left hand side of this exam screen. If you haven't attempted any question, Joy, till now, if you haven't attempted any question from after today's session, you would be having an idea that how to deal these type of questions, how to deal with the ATX paper. Don't worry. Let me also show you the relevant slide. You can see on my screen, I have opened up this paper. It is ATX UK Practice Exam 2, that is updated according to our Finance Act, that is current Finance Act, Examinable Finance Act is 2021. So this Practice Exam 2 is basically updated according to the current fiscal year. Hopefully my screen is visible now. I'm talking about this ACCA ATX UK Practice Exam 2, that is updated according to the current Finance Act 2021. And we can use this navigator on the right hand bottom. From this navigator, you can switch, you can like move in between the questions. As we are attempting section B type questions, we are going to attempt question number 3. So once you click on any question, this screen will be shown in front of you. And the same questions I have opened here in the PDFs as well. as you are having this question in the ACCA CBE practice platform, the same question and the requirements, related requirements, I have opened up in the PDF as well. Yes, the recordings and the PDFs, all of the things would be available. Don't worry. So basically the agenda also includes while attempting these questions, while attempting the section B type questions or question 3 and 4 of practice exam 2, what we are going side by side, we will be recapping the related topics, the related areas, so we can easily apply those concepts in the exam question scenario. So as when we will be reading, when before attempting this question number 3, I would be recapping the relevant concept, so then that you can easily attempt this question. Hopefully the strategy seems to be fine, yes or no, or if you wish we can directly start attempting question, but I would suggest to recap the relevant areas first, then apply the relevant concept on the question. What you guys see? What's your input? How would you like to deal with these questions? Okay, what about others? Any ideas, please? Today's session should not be a one-way communication. It's not like that I'm telling you everything, and I would appreciate your inputs. So do let me know how you want to attempt this question, directly solving the question or recapping the relevant concepts. Okay. This question, there is like, you should assume, sure, I would be recalling the concepts. Don't worry, my dears. You should assume today's date is 7th December 2022. LIBOR has requested advice on the timing of sale of the shares. Timing of the sale of the shares which he acquired in a recent company takeover. From this word takeover is very important for us. His sister Vesta requires advice on the tax consequences of making a lifetime gift rather than leaving an asset in her estate upon her death. So basically there are two persons, both require advice on different matters. The following exhibit available on the left hand side of the screen provides information relevant to the question. Exhibit 1, scenario. This information should be used to answer the question requirements within your chosen response option or options. So here we have this exhibit. To make it readable, I have converted this one to PDF. And don't worry, I would also be sharing the PDF with you guys. Instead of reading this scenario from this exhibit, I'm just going to open the same from the PDF. So now you can easily read what's there in scenario. Although we can read from here, there are it's a two-page scenario. It's a two-page scenario. There are two persons. They require advice on different matters. What are the requirements? For reading requirements, another scenario, another option exhibit is there. It's a 20-mark question. Part A of the question is divided into two parts, A1 and A2. And in total, it's of 12 marks. And part B of the question for 8 marks. I also have this requirements over here in the PDF form. Thereafter, for answering your question, if you want to write theory areas, if you want to answer your solution, if you want to write your answer, you may open up this and you can start by clicking here. You can start answering. And if there is any calculation step involved, simply click on the spreadsheet. Spreadsheet will be in front of you. Then you can use this spreadsheet for performing any calculation. So this is how you would be dealing in exam. Basically, there is one exhibit for scenario, another for requirements, then responses option. You can either use word process or spreadsheet. A spreadsheet mainly for answering the calculation steps, and word processor for mainly answering the theoretical areas. I have all these things in PDFs as well. So as we just decided, we shall be answering to this question, but along with the relevant discussion of the concepts. So I'm going to start this question reading from the scenario, but before reading, I would suggest you always to read the requirement first. My suggestion is to read the requirement first, because if you read the requirement first, then it's giving you an immense idea how to read the question. It should not be a plain reading. If you read the requirements at early stage, then by keeping those requirements in mind, then start reading the scenario, try to find the relevant things which have been asked in the requirement. So it should not be a plain reading then. So before reading the scenario, I'm just going to read the requirements. Requirement A1, and then requirement A2, and then requirement B. As in the basic information of the question, there are two persons, a brother and sister. They want advice on different matters. So it's about first one, explain. Explain means you have, these verbs are very important for us. You have to explain, but with the help of the supporting calculations. It should not be a simple explanation, but you have to explain the things with the help of certain calculations. Explain with the help of supporting calculation the capital gains tax implications for LIBOR of the takeover of V Limited by MPLC on this date on 1st June 2022. You have to tell the implications to a person for this date when the Mercury PLC is taking over VPLC. So basically, it's about the topic of capital gains tax of individuals. I repeat, from this requirement, you just identified that the requirement is pertaining to the capital gains of the individual person, and the relevant concept which is tested here is about, if you remember the name, reorganization, takeover. When a company is acquiring the share capital or the equity of any other company, so that transaction is actually termed as reorganization or takeover. Perfectly fine. Paper for paper relief or share for share exchange, paper for paper exchange. Multiple terms can be used for the same concept. I'm using, why I'm saying that it's takeover, because it is clearly mentioned that we have to tell about the capital gain tax implications for this person at time of taking over the V Limited shares by Mercury PLC on 1st June 2022 and a subsequent sale. It's not only the implication at time of reorganization or takeover, but also to cover the implication and a subsequent sale of his Mercury PLC shares on 1st June 23. So you have to discuss two different aspects. What are the tax implications at time of reorganization or takeover, and what are the tax implications at time when the person would be selling these shares in future time period. So that is the reason 8 marks are available for this part of the question. As we have read the requirement, before the discussion of the solution, I would be guiding you that what is a relevant concept, what is, as this named is, it's available on the ACCA global website. It is practice exam 2 on the CB practice platform. And also we have the same question in PDF. I just downloaded it from the website. However, Joy, I would also be sharing the same after today's session. I would be sharing the PDFs as well. Don't worry. As a person is disposing these shares, subsequent sale of MPLC shares on 1st Jan 2023. The next requirement is pertaining to the previous one. You can see in the part A2, explain with supporting calculation. Again, an explanation is required with the supporting calculation. Why it would be beneficial for Liber to sell his Mercury PLC shares on 1st May 23 instead of this date. As you want to dispose the shareholding on 1st June 22, but in part A2 of the question, examiner is asking you to explain with the supporting calculation, would it be beneficial for Liber to sell his Mercury PLC shares on this date instead 1st Jan 23? By looking at these dates, a general idea, by reading the requirement, we can conclude few points. 1st Jan 23 is falling in the fiscal year 22-23, whereas this 1st May 23 is falling in the next fiscal year of 23-24. So when there is change in fiscal year, if the person delays the disposal of these shares, so simply the person can avail the next year annual exemption and can save the tax liability. But we have to explain all these things with the help of supporting calculation. But for the time being, I have given you an idea what will happen if the person delays the shares disposal. Are you guys okay? Till now we haven't read the scenario, but by looking at the requirements very carefully, if you read the requirement thoroughly, you will come to know that what will be there in, you can have an idea that what would be covered in scenario. But if you clearly understand the requirement, automatically it will be helping you out while reading the scenario, while dealing with the question. All the things are fine. Is there any disagreement with all these things? You may please highlight. And if you guys are okay, we can start reading the scenario. I'm not reading the part B of the question because it's pertaining to other person, Vesta, his sister. So that is the reason I'm not going to read the part B. But as we have done with the reading of part A1 and A2, we can start reading this scenario. Here we go. A person, Liber, he is UK resident and domiciled, has already taxable income of 30,000 each year. If you remember, for deciding the capital gain tax rate, whether person would be giving capital gain tax at 10% or 20% and 18% or 28%. These two rates are for residential property disposal. So which capital gain tax rates are applicable? How we decide this thing? We simply decide this thing by looking at the taxable income of the person, because first of all, the basic rate band limit for this fiscal year is 37,700. This basic rate band limit is firstly covered by the taxable income. If taxable income as per the question scenario is 30,000, so it means in the basic rate band limit, on a second priority, the taxable gains would be covering this band limit. And there is only this basic rate band available to the extent of 7,700 only. It means if the person would be disposing any shares in this fiscal year, the first 7,700 gains will be taxed at 10% at the basic rate at the lower rate of CGT, and any excess gain will be taxed at a high rate of CGT. I repeat, the basic rate band limit for this fiscal year 21-22 is 37,700. This basic rate band limit is normally firstly covered by the taxable income, and taxable income as per the question scenario is given as 30,000. So what's the purpose of giving this 30,000? So basically the purpose of this 30,000 is to cover the band limit. So for this basic rate band is available to the extent of 7,700. So any taxable gains to this extent, they will be taxed at 10% at the lower rate of CGT, and any excess gains, they are going to tax at high rate of CGT. Is this point clear? Is this point clear? Please, everyone, please. All right. Okay. So, labor, the person acquisition of ordinary shares in MPLC. Labor purchased 800 ordinary shares of 40% holding in V Limited for 14,000 pounds on 1st July 2012. Read again. He purchased 800 ordinary shares, which represents a 40% holding in V Limited, and he incurred a cost of 14,000 for acquiring these 800 shares on 1st July 12. Thereafter, Mercury PLC, a new company, an acquirer company, acquired 100% of the ordinary share capital of V Limited on 1st June 22. Basically, the person acquired shares in V, but after some time, after a few years, V Limited acquired by MPLC, and the new acquirer company acquired 100% share capital of V Limited on 1st June 2022. Normally, now let me guide you with respect to the related concept. It's basically reorganization or takeover concept. A reorganization takeover concept normally deals with share for share exchange. Also, sometimes it is termed as paper for paper exchange. Please be with me as I'm going to tell you the few steps. All these same steps are applicable for answering this part of the question. A term of reorganization, share for share exchange, or paper for paper exchange. Let's say I myself, you can assume yourself, you bought, let's say I'm assuming you acquired 10 shares for 20 in X Limited. We are just assuming, we are just creating the scenario for recalling the relevant area. You acquired 10 shares for 20 pounds in X Limited, but after some time, a Z PLC acquired this company and offered you, being existing shareholder of X Limited, I repeat, Who is offering? Z Limited is offering the existing shareholders of X Limited X number of ordinary shares, X number of preference shares, X amount of cash per share. But Z company, this new acquirer company, is offering all these things to the existing shareholders of company X. So that is the reason concept name is share for share exchange or paper for paper exchange. This company is offering you all these new things against the actual shareholding held by you in X Limited. It's basically a paper for paper exchange. Against these, for these, a new acquirer company is giving you all these things. So that is the reason concept name is paper for paper exchange or share for share exchange. Now, continuing further things, that this new acquirer company, what are these X, X and X? May offer at time of reorganization, may offer ordinary shares, may offer preference shares, and may also offer cash against shares. This new acquirer company is offering all these things to the existing shareholders of X Limited against their actual shareholding in X Limited. For example, Z company is offering 2 ordinary shares, 2 preference shares, and 5 cash per share. Let me also guide you few concepts here. You are already having 10 shares. Against these 10 shares, now you are getting all these things at time of reorganization. Total number of ordinary shares will increase by, you would be having a total number of shares 20, 10 into 2. Against the 10 shares, you are also getting the preference shares. Again, you would be having again 20 preference shares. And against these number of shares, you would be also getting the cash per share, the cash element. As you are having 10 shares, 10 into 5, you would also be getting 50 pounds in cash. Before moving on, before telling you any other thing, the cash element which you received at time of share for share exchange, I'm purely talking about this thing. This cash element which shareholder receive at time of reorganization or takeover is taxed immediately. Immediately means it will be taxed in a year in which this transaction is incurred. Whereas the share element will be taxed in future when the shares will be disposed. So what is actually happening at time of reorganization or takeover? If you deal with the share for share transaction or paper for paper exchange, you being a shareholder invested, acquired 10 shares for 20 in X Limited. Then after few years, a new company acquired the X Limited shares and offered these things to the existing shareholder of company X. All these things, the ordinary shares, the preference shares, and the cash element per share is of are given. Against these 10 shares, a cash element of 5 pounds per share is given. But this cash element is taxed immediately, means this cash element will be taxed in a fiscal year in which it received basically. But the share transactions will be taxed in future when the person would be disposing these shares. So basically the part A1 of this question number 3, part A1 of this question number 3 is purely pertaining to these transactions as per the concept we discussed, the takeover. If you read this scenario now, you will come to an idea that how to deal these things. Mercury PLC acquired, a new company acquired the 100% of the ordinary shares of share capital of V Limited, and that person, LIBOR, actually purchased 40% holding in V Limited, but after some time, Mercury PLC acquired 100% share capital of V Limited on 1st June 22. In exchange for each ordinary share in V Limited, LIBOR received the following: 4 ordinary shares in Mercury PLC, valued at 20 per share immediately after the takeover. I repeat, how many shares he already have? 800 ordinary shares. He acquired these shares for 14,000 on 1st July 22. But after some time, due to this share for share exchange, due to this takeover, V Limited shareholders are getting 4 ordinary shares in Mercury PLC, valued at 20 per share, and also 15 pounds cash per share. Thereafter, Mercury PLC has 200,000 issued ordinary shares. Okay. LIBOR has never been a director or employee of either V Limited or M Limited. This statement shows that no business asset disposal relief is given at time of future sale of these shares, because for availing business asset disposal relief, one of the conditions that the shareholding should be of more than 5%, and the person should be the employee of that company. But over here, it is clearly mentioned that LIBOR has never been a director or employee of either V Limited or MPLC. So it means it's about no business asset disposal relief would be given at time of disposing the shareholding in future. The takeover was for bona fide commercial reasons and not for the avoidance of tax. Okay, fine. Then thereafter, LIBOR proposed transaction in Mercury PLC shares. LIBOR now wishes at time of reorganization, he got these shares, 4 ordinary shares in respect of these, the existing shareholding, and also got this cash element, but it's about the proposed transaction, means the future transaction in Mercury PLC shares. LIBOR now wishes to sell all of his shares in MPLC. You can see he never purchased the shares of MPLC. But he got the MPLC shares at time of reorganization. And now that is the reason he is going to sell the shares of MPLC and wishes to dispose the entire shareholding in MPLC. He has received an offer from an unconnected person to purchase these shares on 1st Jan 23 at a price of 28 per share. LIBOR would prefer to sell these shares to his nephew. Nephew is a connected person, Janus. However, this would delay the sales as his nephew will not have the necessary funds to purchase the shares on May 20. Paid 28 pounds per share for getting these shares, for purchasing these shares. But what will be the benefit as he is disposing these shares to an unconnected person? No gift holdover relief can be claimed, but maybe when there is transaction between the connected persons, maybe I'm not saying always, I'm saying that maybe as a transaction in between connected person, gift holdover relief may be claimed, but certain conditions should also be checked. The asset should be the business asset and all that. So can you please read this requirement and think? I'm not asking you to solve this question, as we have read the scenario very carefully. We have discussed about requirement very carefully. Just plan your answer. Please, I'm not asking you to write, but to plan your answer based on the scenario and based on the requirements. What you are thinking, what you should do, because as plan more and write less. I repeat, plan more and write less. If you are not planning, it means then you are wasting your time by writing more and more the irrelevant points. So plan first, plan more and write less. That's the key to pass ATX exam. I'm just giving you 1 to 2 minutes time. By keeping this scenario in mind with respect to the person, he got these shares at time of reorganization, there is proposed transaction. First of all, think what is that, what are the tax implication at time of reorganization. As I just told you, the cash element will be taxed immediately, but if he is going to dispose these shares on 1st Jan 22, what will happen as he want to dispose these shares on 1st Jan 23, but if he delays the transaction, what will happen? So basically, all of these things are pertaining to the requirement A1 and A2. Your time starts now. Think, and then we can start discussing and attempting this question. Thank you. So that is practice exam 2. On the ACCA practice platform, it is practice exam 2 and question number 3. Walaikum assalam. Nabil, yes, your understanding is right, but you told the implications at time of reorganization. It's not only about reorganization or takeover. You also have to think more about the future aspects as well. Yes, I can tell all of you that where from we can download these things, this question, don't worry. As I just clicked on scenario, it's in front of you. Here you can see this option as print. Just click here and it will be asking you to save this document as PDF. That's the way I saved it in PDF form. In case with the requirements, click the requirement button. Over here, you can see the print sign. Then you can convert into print. All right. So now we can start discussing this question. As we have read this scenario, I'm going to create a flowchart here. The person, Liber, he actually on which date? The date is given on 1st July 2012, he acquired a 40% shareholding of 800 shares, and he actually incurred a cost of 14,000 shares. 14,000 for acquiring V limited shares. So basically, LIBOR on 1st July 12, he acquired 40% shareholding by acquiring 800 shares for paying 14,000 as consideration in V limited. But after some time, a new acquirer company named as Mercury PLC. Mercury PLC acquired 100% shareholding on 1st June 2022, effectively in the fiscal year 22-23. And at that time, MPLC offered 4 ordinary shares, 4 new ordinary shares, and no preference share is given, but a cash element also offered against the existing shareholding of the person in V Limited. So what are the existing number of shares? 800 into 4 ordinary shares. So the total number of new ordinary shares are 3,200. Against the existing shareholding of 800 shares, a cash element given as 15 per share. So you can see that. And also the market value of the company share, on this date, on reorganization date is given 4 ordinary shares in MPLC valued at 20 per share immediately after the takeover. So the market value of these shares is given, multiplying it with 20. So the value is calculated as 3,200 into 20 is 64,000, I guess. Whereas an amount of 800 into 15, an amount of cash is also given, cash consideration given as 12,000. In total, the overall worth increased to 76,000. Perfectly answered, Joy. Kunal, your understanding is also correct. I'm actually concluding I'm summarizing all of the points as also raised by you guys. Thereafter, we have to find the cost. Basically, the next step, as we just found the total worth at time of reorganization, worth of LIBOR has increased in total to 76,000. The next step is to find the cost. As you can see, worth of ordinary share is 64,000 and total number of shares are 3,200. And this worth is from a total worth of 76,000. This one into the original cost. Originally, he incurred a value of 14,000 for getting these things. Total cost of ordinary shares and total cost of cash. For finding the value of cash, 1,200 is the value of cash from a total worth of 76,000 into original investment was 14,000. So total cost of ordinary share is calculated as 11,789, whereas the cost of this cash element is calculated as double. The sum of these two should be equal to the actual cost. You can see if you add both values, it's giving you a sum of 14,000. It means you performed correctly. Then in the next step, cost per share. 11789 is the cost of the ordinary share, and basically the total number of ordinary shares are 3,200. So a cost per share is calculated as 3.68 per share. And why I have calculated this cost? Because any future disposal of these shares, at time of calculating the cost, this cost per share will be considered. Furthermore, As I told you, at time of reorganization or takeover, if a person is getting any cash, that cash element is taxed immediately. How this cash element will be taxed immediately? To record the disposal proceed equivalent to the cash received amount. I repeat, for calculation of capital gains taxes immediately in the same fiscal year in which this transaction occurred, record the disposal proceeds equivalent to the cash received amount, which is in total 12,000 of cash received, deducting the cost. This cost we have calculated for this cash element according to the part disposal concept. From 12,000 deducting 2211, giving you a, yes please.
Have you?
Hello, please unmute yourself and then you can ask question. Hello. Then a gain of 9789 is calculated. By the way, you can see is that this transaction is being incurred on 1st June 22, which is falling in the fiscal year 22-23. So this gain has been calculated for taxation in the fiscal year 22-23. Is everything is clear till now? Is there any confusion or unclarity in the working performed till now? Please, your input is very much important for me. What about others, please? Okay, I'm going to deal, as we are done with the discussion of the takeover or reorganization, this cash element text immediately, but a cost per share is calculated and there are no immediate capital gain tax implication for the shares, whether they are ordinary shares or the preference shares. No immediate capital gains tax implication for the shares received at time of reorganization till the time the shares are actually disposed in future. Coming to the scenario again, just to highlight a point, as he got these shares by means of share for share exchange. Yes, because of paper for paper exchange. He got these shares for paper exchange, but want to dispose these shares on 1st Jan 23. Jan 23 is also falling in the fiscal year 22-23. Because fiscal year 22-23 starts from 6 April 22 and it will end on 5th April 23. So as you can see that 1st Jan 23 is falling in the fiscal year 22-23. If he now wishes to sell all of his shares in MPLC, he would be disposing these shares at 28 per share on this date, but also this date is falling in the same fiscal year. But his nephew wants to purchase these shares, but not on 1st Jan 23, but on 1st May 23. You can see the requirement again, and we have discussed the things till now, and a subsequent sale of Mercury PLC shares on 1st Jan 23 going to respond this half of the question now. If person, as we have calculated till cost, if shares disposed on 1st Jan 23, 1st Jan 23 means in the fiscal year 22-23. A disposal proceed will be recorded. What are the total number of shares now held by himself? 3,200 shares. 3,200 shares. If they are disposed at 28 per share, so the total disposal proceed is calculated as 89,600. Then deducting the cost, if he disposed a lower number of shares from 3,200, let's say he disposed 3,000 shares or 2,900 shares, then taking the number of shares, we multiply with the cost per share of 3.68. So that was the reason we calculated this amount. But as he is disposing the entire shareholding, as he is disposing now the all of his shares, so the 3,200 shares cost is directly given over here. So that is a total cost of the 3,200 shares, 11789. After this deduction, again amount of 77,811 is calculated, but this gain is also falling in this fiscal year. You can see that this transaction occurred in the fiscal year 22-23. A cash element text immediately, a gain of 97810 calculated. Person wishes to dispose the shares on this date, but if the shares are being disposed on this date, this gain is also falling in the same fiscal year. So what are the tax implication if both the gains are falling in the same fiscal year? So you can see that on the cash element, gain amount is calculated in the fiscal year 22-23, an amount of 9,789. I'm taking this one, and the shares disposed in the same fiscal year, and the gain amount is calculated as 77,811. Both transactions in the same fiscal year, so the total gains amount 87,600. From the total gains, we can deduct the annual exemption of this fiscal year 22-23, an amount of 12,300. After this deduction, taxable gains are simply calculated at 75,300. First thing to check, simply you can write a note in your solution as few statements are given. So you can write a note in your answer. Note, no business asset disposal relief is available. No business asset disposal relief is available as LIBOR is not employee of company of MPLC. And any one of you can please tell the shareholding. He currently holds 3,200 number of shares from a total share capital of MPLC, which is given in scenario MPLC issued share capital is of 200,000. Any one of you can please tell me the shareholding in MPLC? As he currently holds 3,200 shares from we are talking about MPLC. After takeover, he got these number of shares from 3,200 shares from a total shareholding of 200,000. In 200, it's about 1.6%. Please mute your mics. So basically 1.6% is less than 5%. Based on this thing, we can write in our solution no business asset disposal relief is available as LIBOR is not employee of MPLC, and also his shareholding is 1.6%, which is less than 5%. These are the two prerequisites for having this business asset disposal relief. What are the prerequisites in respect of shares disposal? person should be employee of the company and at least hold 5% shares, 5% or above shareholding or voting rights in the same company. But both of the conditions are not meeting. Both of the conditions must be met, as person cannot avail business asset disposal relief. So these gains will be taxed on the normal rates. Can you please tell any one of you, as I, while reading the scenario, while I start reading, we discussed this concept. Basic rate band limit is 37,700, firstly covered by taxable income as given in question. So this band limit which is available for gains is 7,700. Means any gains, the first 7,700 gains, they will be falling in the basic rate band, and a differential of from 75,300, a differential of 67,600, they will be taxed at high rate of CGT. Basic rate of CGT is 10%, high rate of CGT is 20%. So finally 770 plus 13520, and the total CGT liability is calculated as 14290. Sir, where from you decided all these things? No, it's not simply the high rate taxpayer, Umar Rajput. Please correct your understanding. As per the question scenario, his normal taxable income is given as 30,000. So in the basic rate band, 7,700 is available. To the extent of this amount, capital gain tax rate is applicable. And on the excess amount, high rate of CGT is applicable. So you can see we have attempted the part A of the question. Now you can easily narrate all these things, because as per the question requirement, as per the question 3 part 1 requirement, what is the requirement? You have to explain the things with the help of supporting calculations. You have to explain with the help of supporting calculation the capital gain tax implications for LIBOR of the takeover of V Limited by Mercury PLC on this date and a subsequent sale of his shares on this date. So we have answered this part in much detail. What will happen on or reorganization or takeover date? Cash element will be taxed immediately and gain amount is calculated. And if the shares are also disposed in the same fiscal year, so the gain on the disposal of shares would also be calculated. Then thereafter a capital gain tax liability will be calculated, and the sum of 14290 is calculated. So we are done with the discussion of the first part A1 of the question. Requirement part A2 is also related to this one. There is only a change in the date of the shares disposal. Read requirement again. Explain with the supporting calculation why it would be beneficial. From this requirements word, you can for surely you can say why it would be beneficial. Examiner asking why it would be beneficial, so it means it is beneficial. There is no doubt. Obviously it is beneficial for LIBOR to sell his Mercury PLC shares on this date instead of 1st Jan 23, as he's disposing these shares on 1st Jan 23. But if he delays the disposal of these shares, what will happen then? Obviously the capital gain tax liability, there would be a tax saving. But how? As this disposal is falling in this fiscal year 22-23, and also in the same fiscal year the gain of the cash element is spreading into the same fiscal year, and if we dispose these shares, they are also falling in the same fiscal year. But if it delays the sale of these shares, the next year annual exemption can be availed. The next year annual exemption can be availed. So if next year annual exemption is availed, it means automatically capital gain tax liability will go down. How? Let me show you. We are assuming now if shares disposed, 1st May 23, effectively in the fiscal year 23-24. It means only one disposal in the year. So simply this disposal, this gain will be taxed in the next year. Gain on shares disposal, gains on shares disposal, that is 77811. Annual exemption, we are talking about 23-24 and also considering the previous fiscal year. 23-24 annual exemption will be deducted from these gains, whereas for previous year transaction, gain on cash element, we considered this gain of 9789 in previous year. We considered this cash element gain in previous year. So the previous year annual exemption would be covering this gain. So the previous year annual exemption of restricted annual exemption would be covering this gain. So we just bifurcated the columns and the relevant gains. In 22-23, we are considering only cash element is taxed. In fiscal year 23-24, if based on this date, if the shares are disposed in next fiscal year, so the next year annual exemption can be claimed. After this deduction, taxable gains for each year calculated separately. Taxable gains now in a scenario of 565511 and over here nil. If now we calculate the tax liability again, CGT liability for this fiscal year is nil, but for this fiscal year again, for each year income is 30,000. It means this remaining 7,700 available in band. The differential of 57811, the first 7700 are taxed at 10% and a differential at 20% now. 770 and 11562. A total CGT liability is calculated as 12332, and over here it is nil. So you can see the impact if he actually delays the shares disposal. No CGT liability here in this year, and there is CGT liability calculated in next year to the extent of 12332. So we can write a concluding point: if he delays, if liable delays the disposal till 23-24, capital gain tax liability could be saved by 1958, where from we calculated this 1958. Let me show you. If that is a scenario, the total CGT liability is 14290. If there is delay in disposal, CGT liability, the difference of these two values, 14290 and 12332, strategy 1 and the delaying strategy, the difference is that CGT liability safe, and also would be having more time to pay tax, to pay capital gain tax, as 23-24 capital gain tax, 23-24 capital gain tax is to be paid on 31st Jan 25. If you follow this strategy, the CGT liability to be paid on 31st Jan 24 because it's pertaining to 23-24. So the relevant liability for this fiscal year to be made on 31st Jan 24. But if it delays this transaction and the relevant liability will be paid on 31st Jan 25. We are done with the discussion of the part A1 and part A2. So simply we can say that we have covered the first 12 marks. So you can see these are the easy marks, not the difficult one. It's purely based that how you read the scenario, how you act upon the things. Is there any confusion, unclarity, disagreement? You may please raise your voice. Yes, please, my dears. And in case if you guys are okay, do let me know so we can move forward. As I told you, it should not be a one-way communication, my dears, please. Thank you, everyone. Thank you. Okay, moving forward, the part B of the question. Part B. You can see "66 years old and has never married or had a civil partner." Okay. She is in ill health and expected to die at some time within the next tax year of 23-24. Okay. And she has made no disposals for capital gain tax purposes in the year 22-23 to date, and will not make any in the tax year 23-24. Fine. There's a basic background of the Vesta. Read again. 66 years. She is in ill health, expected to die within next fiscal year. Have not made any transfers in 23-24 and 22-23 and 23-24 in both years, but she has made one previous lifetime gift of 350,000 cash to her son Janice on 1st June 22. That's falling in the fiscal year 22-23. Vesta, investment property. V owns an investment property which has never been used as her main residence. Which has never been used as her main residence means no residential nil rate band would be available, because in IST we know one thing, that residential nil rate band is also available, but to whom? To the person who lived in that property before death and transferred to direct descendant, means transferred to children or grandchildren. But over here you can see that it is clearly mentioned that which has never been used as her main residence. The current market value of the property is less than the price Vesta paid for it, means the value of the asset is declining and its value is expected to fall further throughout the tax year 23-24. Vesta is considering gifting the investment property to Janice in her lifetime rather than leaving it to him in her estate on death. So what's the person wish? To transfer this asset in life rather than leaving the asset to be transferred in estate at time of death. J is the sole beneficiary of V's estate. Yes, very right. Agarwal, you click perfectly. If the asset's value is declining, so there may be a claim named as fall in value claim. Very right, Kunal. As we have read the scenario, Please be with me and try to read the requirement very carefully. Now, examiner is asking you to put an advice to Vesta whether or not, considering both situations, whether or not there are any capital gain tax or inheritance tax advantages for herself or for Janice if you were to give the investment property to J on 31st December 22 rather than leaving it to him in her estate on death. These are not easy 8 marks. I repeat, these are not easy 8 marks. Many aspects are to be considered while answering this part of the question. Basically, you have to advise V, not to her son. You have to advise V whether or not, considering both situations, for two types of taxes, considering two situations. Why I'm saying that considering two situations? Because why or not, whether or these are two taxes or inheritance tax. We have to talk about advantages for herself and for Janus. You can see multiple things have been asked at the same time. Advise a person whether or not in two circumstances, what are the implications, what are the advantages under two taxes, under two head of taxes, if he were to give the IP investment property on this date rather than leaving it to him in her estate on death. Again, before answering this part of the question, I'm giving you like 2 to 3 minutes to think, considering the areas I'm going to mark whether or not, this and that, advantages, herself, for Janus, for son, whether transferring investment property on this date rather than living in a state. I'm looking at chat box as well. I would appreciate if you conclude, if you summarize your points at your own, then I will try to answer. I will try to write the answer of this part because mainly it's pertaining to theoretical aspects. So now we can easily use the CBE practice platform for answering this half of the question. As we are going to talk about the theoretical aspects, so I just clicked on word process. I will mark the reference. We are going to attempt B, part B, and please clearly mention that what you are actually trying to do here. As because it is asked in question to discuss about advantages, capital gain tax and inheritance tax advantages of transferring investment property on 31st December 2022. So that's our heading. Examiner will come to know that what we are going to do here. That's basically our heading. Now we have to answer this part in all aspects. Now you're saying that we'll have case if transferred benefit for her and Janus, if not transferred benefit for both. In both cases, CGTI state advantages. Okay. If gift on that, then no CT. Very right, Wahab. Joy, I'm using phone. Okay, no worries, no worries. Just think in your mind. Even if you don't share here, no worries. As we have to discuss this thing in two aspects for two different persons. I repeat, as we have to discuss this thing in two different heads for two persons, so we can divide. First of all, we will be discussing the advantages for both persons under capital gain tax, and thereafter we will be marking an other heading for IST implications for IST advantages. Under capital gain tax, by the way, we can write it in simple words, as I'm also looking at your answers, as I just divided the things into two different headings. So for the time being, think with respect to the capital gain tax. Yes, you have written the answers in respect of IST as well, but also Asad, Umar, Wahab, all of the other participants would appreciate if you think from the perspective of capital gain tax first, then from IST. Yes, many arguments are mainly there. I can look are pertaining to IST. Okay, good enough. Okay, start writing, please. Start answering. I'm going to start answering if it will be more visible if you extend the screen size. So it's gonna easy for you to look at the answer screen. Any asset which is there, as we are talking about capital gain taxes, any asset which is there in person's estate and person died, on such asset no capital gain tax is applicable. I repeat, if there is any asset which is included in person's estate, then at time of death no CGT is applicable. If investment property is included, no capital gain tax is applicable. Furthermore, what about fall in value relief? Will it be given to person or not? If there is no CGT, so is there any fall in value relief? Very right. Answer is no. Furthermore, due to this thing, no foreign value relief is available. Thereafter, now think with respect to the transfer of property. If investment property transferred to son, transferred to Janus on 31st December 22, an allowable loss will arise. Why the allowable loss will arise? Because it's very clearly mentioned in question scenario that assets value is decreasing day by day. So an allowable loss will arise as a result of fall in value. However, by the way, as we are concluding this point, if the asset is being transferred in life, there would be a loss, but is there any benefit for having that loss? The reason for asking this question, please think smartly. If you are trying to calculate a loss on this asset by transferring this asset in life, is there any benefit for having that loss? Yes or no? Don't decide this way. First of all, look at the scenario. If a loss is calculated, it will not be giving you any adjustment, because however, we will make no other disposals in the same fiscal year. So this loss cannot be adjusted with other gains to reduce CGT liability. Is this point clear? Therefore, transferring asset in life or at time of death has no such implications for V. Let's talk about his son, her son. However, Janus base cost of the investment property on a future disposal is at its market value at the date it is transferred from or by his mother, or it is transferred to him. Okay, by the way, Joy, we are talking about if like any asset is included in straight at time of death, no CGT is applicable, and this fall in value relief is there in capital gain taxes. So if there is no CGT is applicable, no fall in value relief is there. Also, if the asset is transferred on this date, an allowable loss will arise as the asset's value is falling. The current market value of the asset is decreasing as compared to the actual cost. For example, let me guide you over here. For example, if you purchased a property for 200,000, but if you're transferring property on 1st December as the date given, on this date, for example, market value is 150,000. So any asset between connected person is always recorded at market value. So market value in today's date is 150, whereas you incurred a cost of 200,000. So there is obviously, due to fall in value, there is a loss on the asset value at time of disposal. Yes, it's for IST. But as we are talking about capital gain, if this asset is disposed, is transferred on this date, any asset between connected person is always recorded at market value. And although a loss value is calculated as 50,000, but can she adjust this loss in this fiscal year, as she is not disposing any other asset in the same fiscal year? If I wrote any, my mistake, it should not be linked. Okay, if we simply talk about, if there is any asset, no CGT is applicable. If the asset to be recorded at market value, and if the market value has now declined as compared to the actual cost, then obviously there would be a loss calculated. And as per this scenario, person is not like disposing any other asset in the same fiscal year. Person is not going to dispose any other asset in the same fiscal year. So it means if any loss is calculated, can we adjust this loss to get saving in capital gain tax liability? So although there is loss calculated, but this loss is not giving any relief, any adjustment with any other gain. Joy, are you clear with this thing now? Okay, good enough. Okay. Thereafter, if we talk about the other half, I'm going to continue from writing here because I guess that's giving us more understanding rather than typing. Let me write here. As we are talking about J, because we have to discuss the tax implication for both persons under both head of taxes. By the way, for example, today's date is 1st December. Let me guide you with the help of few examples. As they are planning to transfer this asset on 31st December 22. For example, just assume the value of this property is 150. And let's say in future, as per the question scenario, what will be the value of property in future? Would it be increasing or decreasing? As per the question scenario, as the assets value is decreasing, so it means the future value will be less than 150. For example, in today's date, it's 150, and in future, it will be a lower. So what would be the base cost? We are talking about son. Let me guide you other point. What will be the impact on the base cost for her son? In which scenario the base cost would be calculated a higher amount, whether in first scenario or in second scenario. For example, I'm giving you an asset in today's date. Today's worth is 150. And if I don't transfer this asset in today's date, the value of this asset will be declining in future. For you, what is beneficial thing? Would you like to calculate more and more capital gains, or would you like to calculate a lower amount of gains so your tax liability will be a lower amount? Lower the gains, lower the tax liability. What is beneficial from your perspective? Asad, is that second option or first option? Kunal, what's your decision? For CGT, transferring the asset now means on 31st December, I repeat. For example, here is mother, here is son. Disposal proceed in today's date, market value, for example, it's 150. Disposal proceed of one person is the cost for other person. As you know one thing that both of you know one thing that asset value is declining year on year. So would you like to transfer in today's year or in future? If they do this thing on 31st December, let me continue the scenario to make you more clearer. If they do transfer this asset on 31st December 22, base cost for son will be 150, and when the son would be disposing this asset in future, a cost of 150 will be calculated and gain amount is calculated. But for example, if they delay the transfer, if the mother is transferring this asset in future to son, as you have concluded one point, the asset value will be a lower amount in future. For example, when this asset will be disposed in future, maybe the asset's value is declining and future value is 140. So it will become the cost for the other person. Now from the disposal proceed, a lower amount is calculated, a higher amount of gains will be calculated. Are the things clear now? Asad, are you clear? Kunal, are you clear now? So we are talking with respect to son, which option is available is better for son to get this asset in today's date or in future date. So basically for son, we want base cost as higher, because if base cost will up, gains amount will go down. If gains amount will go down, capital gain tax liability will be a lower figure. So transferring asset in today's date is beneficial. Okay. So you can write this point, because we have to discuss the thing with respect to mother and son as well. So transferring asset in today's date would be beneficial for son, because if the transfer is transferred on 31st December 22, base cost will be a higher figure, ultimately resulting in a lower capital gain tax liability if the asset is disposed in the future time period. Yes, exactly, Asad. We are talking about JS CGT. As I highlighted here, actually, however, JS base cost of the investment property on future disposal is at its market value at the date it transferred to him. So by looking at numbers, by considering hypothetical values, you can easily understand the concept now. So transferring this asset in today's date is better for this one, for this person, for Janus. Everything okay with this thing? Yes, guys, please. No, it's not difficult. Basically, the way you think, the way you deal, so that makes it difficult or easier. And by the way, if you do practice 2 to 3 questions like this, so it's gonna very easy for you. Okay, with respect to IST, if the property remains Yes, as you concluded, as your is fall in market value, thus it is beneficial to transfer now. So that cost for Sun is higher and gain would be lower, leading to lower CGT. Very right. You can conclude this way, as I just referred with few numbers. So that's the conclusion. Thank you very much. Let's talk about IST. If a person is not transferring an asset in life, so obviously that asset will be added to person's estate. If the asset is not transferred, it will be added to V's estate. And any asset which is included in V's in person's estate, that asset is always recorded at market value. All of the assets in person's estate should be added at market value except one asset, that is insurance proceeds. If there is insurance policy, ignore the market value of the insurance policy. Rather, we shall be considering the actual insurance proceeds received from the insurance company. So if an asset is not transferred, if we is not transferred this asset in life, so this asset would be added to the market value, would be added to the estate of the person at the market value at time of death. By the way, what will be the impact? Market value in the future is higher or lower? As per the question scenario, market value of the asset is going down and down year on year. Furthermore, for we are talking about all of these things with respect to V. Another point, if we transfer this asset, in life, so any asset which is transferred in person's life to any other person from IST perspective, that is potentially exempt transfer. By the way, this PT is exempt at time of transfer and will become chargeable No, I just stopped my discussion till here. We are not concluding with respect to nil rate band implication, because that not necessary, because nil rate band would not only be covering by this asset only. So that is the reason I stopped my discussion till here. Market value reduces means estate is lower than the more nil rate band is available. Yes, but we as the other assets value is not given, so we cannot discuss this way. And if this asset is transferred in life, for IST perspective, for we it paid, and this potential exempt transfer is exempt at time of transfer, but will be chargeable.
Potatoes is ready. It's not vegetable.
But will be chargeable if we die within 7 years after transfer. Furthermore, as you highlighted, Agarwal, as you highlighted, if an asset is becoming chargeable, a taper relief is there. Okay, and for availing this taper relief, the minimum time gap between the transfer time of asset and the death time of person should be at least a fill in the blank for you guys. Very right. Minimum time gap for availing this taper relief is to 3 to 4 years between the transfer date and the death of person. Very right. But furthermore, as you can see that as a value of the property is expected to have decreased between the date of gift and the date of death, because if the asset is gifted on 31st December 22 and thereafter within the next 1 or 2 fiscal year the person is going to die, fall in value relief will be available, yes or no? Very right, fall in value for surely would be there. But for claiming fall in value relief, there are certain conditions. Let me recall those conditions. The giftee still owns that asset, or if the asset is sold, it's sold at arm's length transaction at a commercial value. For availing fall in value relief, there is one condition, the basic condition, the person, the giftee still owns the property, right? But another point, but no taper relief is available because the date when the asset is transferred, that is 22/23, 31st December, on this date, am I audible to all of you, please? Hello. I repeat the statement, as the value of property is expected to have decreased between the day of gift and the date of death, fall in value is available on the assumption that the person, the giftee, who is the giftee, Janus is a giftee, giftee still owns the property at time of death, and another condition, the last thing to discuss with respect to this scenario, 31st December 22 is a transfer date. If the person is transferring this asset on this date is falling in the fiscal year. 31st December 22 is in the fiscal year 22-23. From this PAT value, normally what we can deduct is that we deduct the annual exemption. The annual exemption of this fiscal year can be claimed or not. Whether this 3,000 is available or not, considering the fact, can we avail this annual exemption? No, because no. He has made one lifetime gift of 350,000 cash to her son on this date. Also, if the investment property is also transferred on this date, can we avail this annual exemption? No, because it has already been deducted from the previous gift. So these points, basically the relevant points, and the points, nothing is given as useless. Be aware of this thing. If this statement is written in exam, it has a link with the solution. It's not useless. So basically, if you consider this, you would be getting around 0.5 to 1 mark if you discuss this point. Nothing is given useless. So if an asset is transferred in the same fiscal year, all of you facing my voice problem, or can all you have the same specific problem? Exactly, yes, sir. It means at time of making this PAT of 350,000, this PAT is being made on 1st June 22-23, annual exemption of this fiscal year, and also the previous fiscal year. Both annual exemption have been claimed from this asset. Because in IST, all of the transactions are being dealt according to chronological order. Chronological order means in a date-wise order. So this date is becoming first. On 1st June 22, this transaction occurred. Thereafter, if investment property transferred on this date, from this PT value, annual exemption is not available. Is this thing fine? I'm just giving you 8 minutes break. After 8 minutes, I would be starting another question number 4. Kunal, with respect to fall in value, after this session in the WhatsApp group, I'm going to share a summary file with respect to the reliefs and exemption in IST. Yes, okay, make it like 10 minutes. And after 10 minutes, we shall be starting the question number 4. Welcome back. Okay. In this question, it's question number 4 of the practice exam 2. You should assume that today's date is 7th December 22. D has recently taken up a new employment and is seeking advice on the tax treatment of certain components of his remuneration package. Basically, it's pertaining to employment income and the relief or reliefs available to reduce the chargeable gain on the sale of his house. One half is pertaining to employment income and the other half is pertaining to the capital gain tax implication on the disposal of a residential property, the house. The following exhibit available on the left hand side of the screen provides relevant information to the question. Number 1, scenario. The information should be used to answer the question's requirement within your chosen response option. Here we have the scenario and then requirements. I'm also going to show you the requirements from here. This question mainly divided into 3 requirements, A, B, and C, and thereafter requirement C also contains 2 part 1 and part 2, and in total it's a 20-mark question. Note, ignore NIC contribution in part 1 and 2 of part C. What are the requirements? As we shall be discussing the relevant concepts before the discussion, before the formal solution of the answer. But read the requirements very much carefully. Explain the extent to which the receipt of 20,000 lump sum inducement payment and the relocation package in relation to D's move to London will give rise to taxable employment income for him. From this requirement, you can see the person would be getting 20,000 at time of joining the job. So what are the tax implications for him under employment income? And a relocation package is also given to him by his employer when he is actually shifting to London. So what are the tax implications at that time? It's about 5 marks. B, identify and calculate. In first, you have to explain the things. In number B, identify and calculate with brief explanations the relief or reliefs available to D to reduce her chargeable gain of 94,000. A gain amount is directly given in scenario by 94,000 on the sale of his house, residential property, or we can say it as principal private residence if the person is living in that house before disposing. So that is the principal private residence. On the sale of his house in Manchester on 31st October 22. It's about 6 marks. C, explain with supporting calculation. You have to explain with the help of supporting calculations the tax consequences for D of the participating in P Limited's approved occupational pension scheme in the tax year 23-24. By this word, if employee is contributing in occupational pension scheme, if employee is contributing, what is the tax implication? And if employer is contributing, what are the tax consequences? Any input from your side? It's not the personal pension contribution. We are talking about the occupational pension contribution. For the time being, we don't know who would be contributing in this pension fund, but I'm just creating a scenario if the employee is contributing in if the employer is also contributing into the occupational pension scheme, what are the tax implications? Very right. Employer contribution will be a deduction from the employment income, whereas employer contribution into occupational pension contribution is an exempt benefit for employer. So what is the actual scenario? We will come to know after reading the scenario who is contributing into the occupational pension scheme. But as we discussed, employer contribution is a deduction from employment income, whereas employer contribution is an exempt benefit. Number two, explain and with supporting calculation. Number two, P Limited's non-tax or unadvantageous unapproved share options scheme. P is Limited's non-tax advantaged or unapproved share option schemes in respect of the grant of the shares on this date. We have to talk about the tax implications on the grant date, and these shares are the unapproved share options. And thereafter, the tax implication on exercise date and the subsequent disposal, the sale of these shares on 6 April 28. So basically, share options schemes are categorized into two categories: the approved share options scheme and the unapproved share options scheme. What is the basic difference between the approved share options and unapproved share options? Be with me and try to listen carefully. Unapproved share options schemes are those share options which are not according to the taxation laws and rules and regulations. I repeat, unapproved share options schemes are not as per the tax rules and regulations, whereas the approved share of options schemes are those share options schemes which are according to the taxation laws and rules, which are also approved by taxation laws. So those are any share options which are also approved by under taxation laws. Those share options are approved share options scheme. And for both type of share options, whether approved or unapproved, there are no tax implications at grant date. For both type of share options scheme, there are no tax implications at time of grant date, but there are tax implication on exercise date and also on the future disposal of these shares. So here we have the scenario with respect to unapproved share options. We have read the requirements, and let me show you the scenario now. Mr. D, who is UK resident and domiciled, commenced employment with P Limited on 1st December 22. Will have no source of income other than salary from P Limited in all relevant future tax years. Okay. He will be a high rate taxpayer in all relevant future tax year. High rate means he would be paying any income tax at 40%. Has relocated to London from Manchester, a city more than 150 miles north of London, to take up his new employment. His new employer is based in London and the new employer name is P Limited. Remuneration package from P Limited. D will receive an annual salary of 220,000. That is the reason it is marked as person's status is high rate taxpayer. Or you can see as it's more than 150, so we can also write it as that the person may be an additional rate taxpayer. But as per the question scenario, he will be considered as high rate taxpayer in all future tax years. Okay. The date when he joined employment on 1st December 22, P Limited make a one-off lump sum payment of 20,000 to D as an inducement to take up new employment with the company. Any amount which a person is receiving under employment that is taxable. The simple rule, any amount which is being received under employment that is taxable. P Limited paid D 5,000 towards his cost of relocation to London. If you recall, relocation in employment If we talk about exempt benefit, there is a long list of exempt benefit, and one of the exempt benefit is relocation. The first 8,000 of the relocation is exempt. If the person is getting amount in excess of this, the excess amount will become taxable. Yes, you are right. Agarwal, your answer is fine. Kunal, you are also perfectly answered. Relocation of first 8,000 is exempt and the excess amount will become taxable. The company is also paying him 1,500 each month for the 4 months from 1st December towards the renting accommodation in London until he purchases a new house on 1st April 23. Okay, for the 4 months, company is also paying 1,500 each month. 1,500 into 4 is giving you 6,000. So basically 5,000 in respect of relocation plus 1,500 into 4, 6,000 in total, 11,000 he received. Actually, the first relocation to the extent of 8,000 is exempt, and the excess amount of 3,000, the difference of these two amounts will become taxable. On 1st December 22, when he joined the employment, D was granted share options. D was granted share options in P Limited, which are non-tax advantageous and approved share options scheme. At grant date, no tax implications. At grant date, no tax implications. And from the next year, from 6 April 22, D will participate in P Limited's approved OPC occupational pension scheme. Here is a journal scenario about D, then about the remuneration package with a new employer, then relocation to London. D incurred cost in relation to his residence to London of 6,000. D incurred cost of 6,000. This amount includes the estate agent fee of 2,800 in connection with the sale of his house in Manchester on this date. And also D signed a 4-month lease for a flat in London from 1st December at a monthly rent of 1,700. So he is actually incurring cost 1,700 a month for 4 months, an amount of 7,200 plus 2,800. He is incurring these costs for taking up new employment with the new employer. And once he sold the house in Manchester, it resulted in a gain of 94,000. But we know one thing, that when the person is disposing any main residence for CGD purposes, it is a disposal of the PPR, and from the PPR we may claim one or two types of reliefs. Can you please? One or two types of reliefs, either one or two. So there may be two types of relief. One of them is PPR exemption and another one is letting relief. PPR relief or letting relief, I can rephrase this statement, Kunal, as PPR relief or and letting relief. Both type of reliefs can be claimed from the gains amount. When to claim PPR only? When the person lived in that house, not rented out. But when to claim also the letting relief? When the person has let out the same property in which he was living. D purchased the house on 1st Feb 10 and lived in it as his main residence. Okay. D let the top floor of the house, comprising 30% of the total house, to tenants from 1st Feb 12 to 31st October 22. From this date till the disposal time, the tenants did not share D's living accommodation or to take meals with him. It's not necessary for letting relief. There is a condition: the property should be let out from the main residence, or we can rephrase this statement as the owner of the property should be in the shared occupancy with the tenants. Means the person who actually let out the house would also be living in the same property in which the tenants are living, so that the person at time of disposal can also claim the letting relief. and D continued to occupy the remainder of the house as his main residence until 31st October 22, when the entire house was sold. On which date house was sold? On 31st October 22. The sale gave rise to a gain before any relief. The amount of gains are 94,000. D did not own any other house throughout the period from 1st Feb 10 till the disposal of this house 31st October 22. Thereafter, these pensions contribution, D has made tax allowable contribution of 40,000. For getting the letting relief, as you are asking a question, let me guide all of you for availing, for deducting, for claiming letting relief. The basic requirement, the basic prerequisite is the owner, the landlord, the person should be in the shared occupancy with the tenants. It is evident from the scenario when he let out the property to tenants, the 30% of the total house, they continue to occupy the remainder of the house as the main residence. He is in shared occupancy with the tenants. It doesn't matter whether the tenants are sharing meals and other things. It doesn't matter. The basic requirement in the letting time period, the owner of that house is in the shared occupancy with the tenants, and this condition is meeting over here. Is this thing fine? Is this thing clear? Okay. D has made tax allowable contribution. The person has already made tax allowable contribution of 40,000 gross. If this amount is given net, we have to make it gross. How we can make it any amount as gross? Take the amount and divide it by 80%. So the gross amount will be calculated. But if an amount is directly given at gross, no need to gross it up. D has made tax allowable contributions of 40,000 to a personal pension plan. It's not about occupational pension, it's about the personal pension plan for last 5 years, and will continue to do the same in future tax years. Okay, from the tax year 23-24, from the next fiscal year after joining his employment, person's employer, the company P Limited, will contribute an amount equal to 10% of D's annual salary into an OPC, occupational pension contribution. So what is the basic salary of D? At time of joining, the annual salary is 220,000. An amount of 10% of 220,000, 10% is giving rise a value of 22,000. If the employer, if the company would also be contributing into the pension fund, we have to check further things with respect to the what is the threshold income, what is adjusted income. Before the formal discussion, I would be recalling all these areas, but let me finish the question reading first. D will make no contribution to P Limited's occupational pension scheme. Okay. P Limited share options scheme. On this date, at time of joining the employment, P Limited granted D option over 3,000 shares in its non-tax advantageous share options scheme at 5% discount on the market value of the shares on that date. The market value of P Limited shares on this date was 4.2 per share. D will exercise the options after a few years on 6 April 28 and immediately sell the shares. P Limited believes that the market value of its shares in future on this date will be 6 per share. So examiner has also asked you in the last requirement, what are the tax implications at grant date, what are the tax implications at exercise date, and what will be the tax implications on the future disposal of these shares. As we have read the question, let's try to conclude, let's try to summarize few points before answering this discussion. I'm going to start discussing one by one. And in case of any unclarity, you may please highlight your point, then I can refer you to the relevant area from the question requirement or from the scenario. If you are unclear with any of the point which I'm going to discuss now, please do raise your voice. I would be referring you to the relevant area from the requirement or from the scenario. We are talking about requirement A, discussing the concept side by side. In requirement A, what you are supposed to do is that explain the extent to which receipts of 20,000 payment and relocation package in respect of D will give rise to taxable employment income for him. So basically, answer should include the discussion points are here with respect to two things, a lump sum amount and the relocation expenses. And few things we have already concluded while reading this scenario. First of all, 20,000 amount is it taxable or exempt? The endorsement package which he received at time of joining the employment, what about this 20,000? Is that taxable or exempt? This one-off lump sum payment, is that taxable or exempt? It is simply taxable. Yes, it is taxable. Why it is taxable? The reason is very simple. As he joined the employment, at time of joining for underemployment income, any amount received that is normally taxable. If that amount is received at time of joining the employment, still that amount will remain taxable, not exempt. Furthermore, if we talk about relocation, in respect of relocation, he basically received two amounts. One amount in respect of 5,000 as relocation, plus furthermore 1,500 for 4 months rent, and we have concluded an amount of 11,000 earlier. From the 11,000, the first 8,000 is exempt, and the remaining will become taxable. Not whole amount, but the excess amount. This 8,000 is exempt under relocation expenses. The excess will become taxable. But if you have noticed why this paragraph is given, have you ever noticed that why all this information is given? This one. Why this information is given? What is the objective? Although we have answered our requirement here with respect to this 20,000, with respect to this relocation, the first 8,000 exempt, excess taxable. So what is the rationale behind this discussion? Think why these 2 points and the related information is given. Very right. You are saying that this show the actual expenses is incurred, I think related to employment income. Basically, this information is purely pertaining to the relocation, and by giving these 2 points, just to confirm you one thing, that the person, the employer, has actually incurred expenses in respect of relocation. as 8,000 is exempt, but also he incurred actual expenses in respect of all these things. So basically exemption, it's not only there, it's not a general exemption 8,000 exempt. For getting that relocation, exemption, there should be actual expenses which should be there, which should be incurred there. So you can see that he incurred actual relocation of 6,000. Thereafter, he also paying 1,700 for 4 months, 7,200. So all these amounts have basically incurred in actual. And over here, you can see one more point. The actual total cost is becoming more than the exempt amount. So basically, these 2 points are given. For this confirmation, the person has actually incurred few expenses. Thereafter, if we talk about the second half of the chargeable gains, at time of disposing this PPR, gains of 94,000 are given. If expenses are lower, you have to reduce the amount of exemption. You cannot take the exemption to that extent. If you're incurring lower amount of expenses, then it may result in the reduction of your exemption amount. If the gains amount of 94,000 are given, and as per the scenario, we can deduct both types of reliefs. One of them is PPR exemption, and as also evident from the scenario, person also rented out this house. So letting relief is the lowest of. We don't know for the timing what is the lowest amount, but for surely we know one thing, that if these exemptions and reliefs are deducted, so then chargeable gain in respect of this disposal of residential property are calculated. Now, would appreciate if you start performing few calculations with me. What are the rules? What are the things to claim PPR exemption? And how to calculate this letting relief? Any idea? If you look, you purchase this property on 1st Feb 2010 and the disposal date is 31st October 22. Simply count the time period of the ownership. He owned this house basically for 12 years and 9 months. In total, it's becoming 153 months. Can you please confirm this thing? Okay. Thereafter, for getting PPR relief, the formula is month occupied divided by month owned into the gains amount. Or we can write it as period occupied. Let me write the formula here to make you clear. Period occupied divided by period owned into the gains amount, whereas gains amount is directly given in question as 94,000, the same figure. And we also calculated the period owned, that is 153 months, but this period occupied is actually the sum of the actual occupied and deemed occupied. Period occupied is calculated as by considering two things, the actual occupied time period and the deemed occupied time period. Actual occupied means the time period actually person lived in that house, and deemed occupied means if the person is not living in that property in actual, but HMRC allows you to count that period as deemed occupied. And deemed occupied is based on 4 different things. Deemed occupied is based on 4 different things. In deemed occupied, 4 things can be considered. No last 6 months, last 9 months before disposal. Number 1, last 9 months before disposal. Number 2, any unlimited period for which the person was abroad due to employment. Any unlimited period for which the person was not in UK due to job in abroad. Any number of 4 years, any 48 months when the person was in UK but not living in that house due to the employment. Although person is in UK but not living in UK house due to employment, but that time can be considered to the max of the 48 months, and the last 36 months due to any reason. So what is number 1? Deemed occupied is number 1, last 9 months before disposal. Number 2, any unlimited period for which the person was abroad due to employment. Number 3, any 48 months person is doing job in UK but not living in UK house due to employment. And number 4, any 36 months due to any reason. In these 4 scenario, if the person is not living in UK house but still HMRC allows you to count these months as deemed occupied. By the way, considering these months as deemed occupied is beneficial for thing, because as the number of period occupied is increasing, the PPR exemption will also be increasing. As the numerator is increasing, the PPR exemption would also be increasing. Okay, so to decide what should be the period occupied, let me guide you from here, from the purchase date, from 1st Feb 10 till 1st Feb 12. Where from I'm getting these dates? I'm getting these dates from this scenario. You can see that from 1st Feb 12, from on this date he purchased the house. From 1st Feb 12, he let the house to tenants. It means for the first 2 years, it means purely for the first 2 years from 1st Feb 10 to 1st Feb 12, a time period of 2 years means 24 months is basically actually occupied when he only was living in that property and no tenants were there. Thereafter, I'm considering last 9 months before disposal separately because they are always considered as deemed occupied. From 1st Feb 12, from 1st Feb 12 till 31st Jan 22, I'm going to count it separately because from 1st Feb 22 till the disposal time of what is the disposal day as per scenario? 31st October 22 is the disposal date. 31st October 22. These are the 9 months. 9 months are always considered as deemed occupied. But what to do with the differential of these 10 years? From 1st Feb 12 to 31st Jan 22, it's a time period of 10 years. It was a time period of 2 years. For these 10 years, means total of 120 months. 10-year means total of 120 months. Now, should we consider these 120 in total, or is there any other calculation with respect to these 120? Think. Between these dates, he also let the property out to tenants. For these 10 years time period, he was not only who were using the property, Also the tenants were also living in that property, and the private use portion from the 120 months is the 70% of the property, because 30% actually let out to tenants. From the 120 into 70, so basically it's giving you 84. So these 84 months, 24 months, 84 months, and 9 months before disposal, the sum of all these is becoming the period occupied. And the period occupied months in total are becoming 117 months. From 117 divided by 153, the period owned, period occupied divided by period owned into the gains amount. So basically 71882 is the PPR exemption, whereas this letting relief, this letting relief is the lowest of three things: an amount fixed 40,000 given by HMRC, gains under PPR exemption. How much gains are calculated under PPR exemption? 71882. Gains under PPR. What we are actually trying to find, the letting relief, which is the lowest of three things. 40,000 is a fixed amount given by HMRC. Gains under PPR exemption or gains under letting relief. And gains under letting relief are to be calculated now. Gains under letting relief are to be calculated now here, as he let out this house for 10 years. As he let out this house for 10 years, I'm not considering the last 9 months before disposal, because they are always considered as deemed occupied. For the 10-year time period, if we convert it into months, 120 months are there, and 30% portion was actually let out to tenant. 36 months calculated, and letting relief is calculated in the same manner. Let out time period divided by total month owned 153 and multiplied with the gains amount, that is 94,000. So an amount of gain is calculated as 22118. So gains under letting relief are 22118. If we compare all these three figures, then the lowest amount is 22118. If we deduct this 22118, so resultingly the gains are becoming nil, because from the 94,000 gains, few are basically covered by PPR exemption and the rest of the gains are covered by letting relief. So this is how we can simply answer the requirement B of the question. As it was about identify and calculate with brief explanations if the relief or reliefs available today to reduce the chargeable gain of 94,000 on the sale of this on this date. So we have answered for 6 marks that from the 94,000 gains, few gains may be covered by PPR exemption, and the rest of the gains may also be covered from, may also be relieved from letting relief. But how the things will work, we explained all these with the help of example. Is this thing clear? Is this working fine for you? There are also other options available to deal such workings. These are the mass working, you can present your answer in any manner. Is this thing fine? Yes, my dears. Okay. If you remember the scenario, it's about pension contribution. He has already contributed an amount of 40,000 into personal pension, but his employer will be contributing an amount of 22,000, the 10% of annual salary, into the occupational pension scheme. So what are the implications? Keeping the requirement in mind, explain with supporting calculation the tax consequences of D participating in P Limited's approved occupational pension scheme in the next year. But who is contributing? The employer is contributing. For employment income purposes, employer contribution into occupational pension scheme is exempt. I repeat, from employment income perspective, employer contribution in occupational pension scheme is exempt benefit, but it has tax consequences according to the pensions. And whenever there is pension, few things which should come to our mind, like for checking the pension contribution limit, a person can, I'm just recalling the entire concept, a person can contribute into the pension fund to the higher off. Remember, higher off, two things: an amount which is given by HMRC, fixed amount 3,600. This 3,600 to be compared with the relevant earnings, and relevant earnings comprises of three things: employment income, FHL property income, and trading income. Relevant earning is a sum of three things: employment income, FHL property income, and trading income. And relevant earning is any income which is earned by doing some efforts. What is relevant earning? Relevant earning is an income which is earned by doing some efforts. Now, let's say in a case where the relevant earning is more and more and more, can person is that person is allowed to make any unlimited amount in the pension contribution? Answer is no. I'm assuming, I'm creating the scenario, I'm asking a question. Let's say a person's relevant earning in the year is, let's say, 100,000 or 200,000 or 300,000. Is there any specific limit? Is there any specific restricted limit for pension contribution? Yes, there is a specific limit. How to calculate that specific limit? This specific limit is comprises of four things. Please be with me and try to understand the concept with respect to pension. It will be helping you out for every type of question with respect to pensions. Let's say relevant earnings are more and more. Is there any specific limit? Yes. How to calculate that specific limit? For the calculation of specific limit, four things are there: the annual limit of current fiscal year, and our current year fiscal year is 21-22, or it may be any other year, and the previous 3 fiscal years unused annual limit. Unused annual limit. Why I'm writing it thrice? Because as per the concept, 3 previous fiscal years annual limit can be brought forwarded. From 21-22, what are the 3 previous fiscal years? 2021, 19-20, and 18-19. But for broad forwarding this previous year's annual limit, person should be the member of the pension scheme. Person should be the member of the pension fund scheme. By adding these amounts, By adding all these four amounts, you will be getting the specific limit for that person. However, I have to discuss more points with respect to the first step. And if person is contributing less than this amount, contribution is less than this amount, no annual allowance charge. If pension contribution is more than this specific limit, there is annual allowance charge applicable to the topmost rate of tax according to the tax rates and slices. And back to the concept, annual limit for this current fiscal year is 40,000. An amount of 40,000 is normally standard amount of 40,000 is available here. And these amounts are pertaining to the contributions made in previous fiscal year. So the unused annual limits can be brought forwarded. But my discussion point is this 40,000, which is current year annual limit. Furthermore, what to do with this 40,000? Are you guys remembering the concept? Anything to check here? Silence shows tapering of this annual limit is there. This 40,000 is subject to tapering actually. This 40,000 is subject to tapering. What exactly is this tapering? My next discussion is purely now pertaining to this area. Tapering of annual limit of 40,000. Tapering is there when adjusted income is equal or more than 240,000, then 40,000 amount will be reduced but restricted to minimum 4,000. Agarwal, Eva, Joy, are you getting these points? Are you aware of these things? All of you, please. Kunal. This 40,000 amount is subject to tapering. How it will be tapered if adjusted income is more than 240,000. For example, adjusted income, let's say 250,000. It is more than 240. Excess amount is 10,000. This excess amount is to be divided by 2. Tapering step is same like the tapering of personal allowance. This 40,000 amount is given by HMRC. It's not given by me. That's the standard amount of the annual limit. For pension contribution for each year for current fiscal year, annual limit is 40,000. That's the standard amount given by HMRC. And also given the tax rates and allowances of the ATX paper. But this 40,000 will be decreasing, will be tapered when the adjusted income is more than 240,000. For example, we just assume adjusted income is 250,000. The excess amount is calculated 250 minus 240. And again, you would be asking where from I'm getting this 240. So annual limit of 240,000 and this threshold, this 240,000, both are the standards amount given by HMRC for checking the tapering of annual limit of 40,000. And over here, I'm assuming 250,000 is the adjusted income. If it is more than 240,000 excess amount is calculated. This excess amount is to be divided by 2, 5,000 is calculated. Then in the next step, we can say that standard annual limit is 40,000. Standard annual limit is 40,000. Reduction in annual limit due to tapering is by now 5,000. So available annual limit will be of 35,000. So instead of 40,000, now we have to use an amount of 35,000 here. So this is how this amount will start tapering if adjusted income is more than 240,000. But this amount can go down this way. But if the amount over here, for example, it is calculated as 25,000, that's fine. If it is calculated as 10,000, that's fine. If it is calculated as 5,000, that is also okay. If it is calculated as 4,000, that is okay. But if this amount after all these calculation is calculated as, let's say 3,500 or 2,000 or 1,500, no. A minimum amount of 4,000 should be there. So this, the tapering will be stopping. This amount will be tapered, but a minimum, but should be restricted to minimum of 4,000. It cannot go down than this 4,000. After tapering, we will be adding all these things. But another concept is here, when you would be checking the tapering of annual limit, when you would be checking this adjusted income at the same time, there is also another concept here about the threshold income, threshold income. If threshold income, if TI is equal or more than 200,000. Now, where from I'm getting this 200,000? Again, that's given by HMRC as 240,000. For comparison with adjusted income, this 40,000 is 240,000 is given by HMRC. Same case over here. For comparison, for the comparison of 200,000, this amount is given by HMRC. We have to compare this threshold income. If threshold income is equal or more than this 200,000, tapering of annual limit will be there. If threshold income is less than 200,000, no tapering of annual limit. So as person has already contributed an amount of 40,000, but if the employer is also making contribution of 22,000, the 10% of the salary, it means there would be an excess amount calculated. If there is an excess amount calculated on such amount, annual allowance charge will be applied. And by lack of participation specifically for this area, I can say that you have not revised such kind of things with respect to the pensions. Kunal, let me show you from a detailed slide for your clarification. Just give me a minute. I'm just opening up a slide. And if you guys want, I can also share the same slide after this session in the WhatsApp group. So these are the relevant steps whenever there is a question pertaining to pension contribution. These are the steps. Step 1, check the max of higher of 3,600 or the relevant earning. Then step 2, check about the threshold income. Threshold income is less than 200,000, no tapering of annual limit of 40,000. If threshold income is more than 200,000, tapering of annual limit might be applicable. Why I have written this might? Because the next step, the step 3, is to check the adjusted income. If adjusted income is more than 240, no tapering of annual limit. If adjusted income is less than 240, no tapering of annual limit. If this adjusted income is more than 240, then tapering of annual limit will be applicable. Number 4, check the specific limit, including the 3 previous year brought forward annual limits. Then assess whether contribution is more than the specific limit. If person have contributed more than the specific limit, annual allowance charge will apply. If the contribution is less than, and in the next table you can see how the adjusted net income, how the adjusted income, how the threshold income are calculated. ANI is purely used for the calculation of the tapering of personal allowance, whereas the adjusted income and threshold income, these both are checked for in the pensions topic for the tapering of annual limit of 40,000. So I would also be sharing the same file for revision purposes. I would be sharing the same file. I'm not going to continue the question because lack of participation shows that you are not have revised this area, I guess. So I would suggest to revise this area before attempting this question. And this slide, which I will be sharing tomorrow in the WhatsApp group, will be helping you out to deal with the scenarios. And these are the notes which are pertaining to different to the entire income tax. There would be no other live sessions, but we'll also be sharing the other recordings wherein we discuss the questions and the implications and all that. As Circumber and myself, we conducted the ACCA practice to pass webinar in March 22 earlier this year. We also conducted a webinar on ACCA platform. So you may also find the you may also follow the Vimeo channel of ACCA. And furthermore, we shall also be sharing further practice questions. We have a lot of stuff to share, but it depends on you that how you tackle, how you cover the things. I hope you all of you have been added to WhatsApp group. If you have not added in the WhatsApp group till now, 923-223-787-312. That's my personal number. You can direct message to me. As Kunal, you're asking something. We can discuss here. Just write your name and we shall be adding you in the WhatsApp group. I repeat, 923-223-787-312. In case of any question, query, you may please ask questions here and also in the WhatsApp group. Everyone, please. And I'm going to conclude today's session now. Any questions and queries? No, there would be no more live session, but yes, we are here to help you out. You may ask questions in group or in person. All right, students, take care. Bye and good luck for your exam. Please don't hesitate to ask any questions. Thank you. Thank you, everyone. Thanks for your time for joining this session. Yes, we have some price notes. You would be getting a lot of stuff in the WhatsApp group. Don't worry. All right, my dears, take care. Bye and Allah Hafiz.